Hello and welcome to Women on Top with Haleh Moddasser, where the conversations focus on women, wealth, and social change. Haleh and her guests, who represent many different fields, engage in transparent conversations that reflect professional and personal struggles as well as accomplishment. Some are making strides to address societal problems. Others have chipped away at the proverbial glass ceiling. All are supporting the financial future and well-being of women. Through these conversations, we learn about embracing a purpose and lifting others up while ensuring our own future success. Now, here's your host, Haleh Moddasser.
Hello, everyone, and welcome to another episode of Women on Top, Women, Wealth, and Social Change. I'm Haleh Moddasser, and I'm joined today by Beata Kirr, Managing Director and Chief Impact Officer of the Copia Group. That's a private credit fund that focuses on underserved populations. Beata, welcome.
Thank you so much, Haleh, for having me. It's really a pleasure to be with you.
Well, we're delighted to have you. Take a minute, if you would, and tell our audience a little bit about yourself.
Well, what a loaded question that is, right? What's most interesting about myself? In terms of relevance for your audience and this show, I've been a female investor, right? Obviously, a woman investor in a world where there's really not that many of us for my entire career. I started on Wall Street at Goldman Sachs, came out of an undergrad in finance and thought this would be a good idea to enter this industry. And I'll fast forward from those early days to the majority of my career. I was at a private wealth organization for 16 years as a portfolio manager, which really meant that I was allocating capital for our clients, finding the best fit for them of all the investments that we had, and ultimately building the investments that we had for clients. So I was really grateful to have a long career at this firm and ultimately became their co-chief investment officer. So that's notable in the sense that I left that firm last year to go join the Copia Group. As you said, we are a newer firm and a newer fund. And I did that to fulfill my purpose and passion in the private markets of getting capital to where it doesn't most easily flow. And what do I mean by that? Underrepresented populations. So people of color and women-owned businesses is our primary target. So that's what I'm up to today, is really identifying those firms and identifying the impact that we have in getting them capital.
Let me step back a second. When you were at the other firm where you spent the majority of your career, I mean, this is not a new concept for you. I believe at that time in your career, you specifically worked on a women's platform as well. Is that right?
I did. I launched what was called Women in Wealth, which was similar to what you're doing here, but this is fabulous what you're doing, Women on Top, because the reality is that women are controlling the most amount of capital that they have ever controlled, whether that is through divorce, whether that is through themselves being the breadwinner, or whether that is through inheritances, that this is a generation of women that are taking charge of their wealth in a way that has never happened before. And a lot of that is through transition, but a lot of that is also through climbing their way to the top. And so I really enjoy those conversations and around women's engagement and literacy with their wealth, because they're not necessarily easy decisions. Sometimes it's sudden wealth, and that's very scary. Sometimes it's not sudden wealth. Either way, what we wanted to do was really facilitate the conversation in a way where we're getting rid of taboos around women talking about money. And as I know, and you do a lot of work in this space, there is still that taboo. And so just women talking to women about money is a good thing, because there's real power in money. And we know that to be the case. So I did spend a lot of time with women, and I loved that aspect of my role.
Yeah, I think it's very interesting that it's not that women just control a lot of wealth more than they ever have. They actually control a majority of wealth in the country today. Something up to 20 trillion. I think the expectation by 2030 is $30 trillion of wealth, which is on par with our nation's debt, just to put this into perspective. This is a lot of money, and yet finance has been historically the purview of men. And so women tend to delegate investment decisions to their husbands, to their male advisors, to their sons, to their brothers, even though there's a survey out there that shows that only 12% of boomer women believe that men are better investors than they are. So I'm not sure what that means, but except that we're trying to keep the peace, but I think we're not helping ourselves by not trusting ourselves with our own finances and trying to actually use our wealth to shape the world that we want to see.
Well, I applaud you for citing those statistics and for working to make change. And it takes women such as ourselves, whatever side of the equation we're on, big firm, small firm, asset allocator, investment manager. It really takes a force of women to move against the forces that have been conspiring against us. And I just want to double click on one thing you said. It's not our fault, right? Because there's all of these gaps that add up over time to create that challenge. And one of the things I thought was most interesting was that I learned a long time ago that there is a gap that starts really young in terms of how families even talk to their kids about money. And unfortunately, families at the dinner table are conversing more with their sons than their daughters about all of the various aspects of finance, whether it's as simple as what's a weekly budget or whether it's about the family wealth. So if you think about it, if it starts that young, that kind of conspiracy adds up over time to these gaps. And then I think when you get into the world of making decisions around investments, there's a tremendous alphabet soup, these acronyms that get floated around. That's ridiculous because anything that you can't explain, you shouldn't do, right? And I think women just have to know that never is there a stupid question. And in fact, some of the best questions I've seen asked by women in their simplest form, because a lot of times just asking the question about how do I get paid back, or why are the fees so high, or why are the returns so difficult to describe, are really the best questions in the room. So
Or
I think it's just empowering.
How risky is this? I have to tell you that I was quoted in the Wall Street Journal one time. I did this long interview and only one line was quoted. And this tells you a lot. It was, it's not sexy for women to talk about finance.
Mm-hmm.
I mean, that
well,
says
let's make
everything.
it sexy.
Yeah,
Why
let's
is
make
it not
it sexy.
I mean, I think we're sexy.
I mean, you're definitely sexy. You are sexy.
I think that's a problem because why is it that for men this is such a normal topic? And we've talked about this just getting to know each other, that on the weekends, right, we spend a lot of time focused on logistics and meal planning. We get all this inbound on our kids' activities. But I found something interesting in my community that a lot of men were interested in talking to me, and what deals was I looking at? Where was reallocating capital? But why weren't the women talking about that? And so I really am trying to change the narrative on that. And I know you are too. So the more we talk about it, let's just hope the more we get sexier and it gets sexy.
Well, I want to hear about the very sexy decision that you made to leave a very secure and profitable career, right? I mean, you did this for a long time. You had power, you had security, you had a lot of things. And yet something inside of you made you take a leap for something that you believed in. And I want to hear what you think motivated you to do that and actually take that leap.
Well, I think the answer is not going to be that surprising to you, right? Because I think women in transition at a certain age in life is a whole nother set of topics and podcasts to explore. Look, life is a marathon. If we're lucky, it's a marathon, right? And we know that our time is not guaranteed. And unfortunately for me, that became very clear because of a personal friend who died of lung cancer far too young. She was 47. She battled the disease for 4 years and she had tremendous access and the most cutting edge medicine. But our daughters were good friends and she was a dear friend. And so it is very true that as I was sitting at her funeral, I really started to think, and I started to think about not seeing that guarantee of time and thinking about what was the best place for my so-called, time, treasure, and talent. In philanthropy, that's often a term that's talked about, but it shouldn't just apply to philanthropy. I think this idea that when you recognize life is not guaranteed, that your time is unclear, and you really start thinking about the impact you're making, that's what started to crystallize for me. Because in my former life, I was very lucky to have had this career for a long time and get to the upper echelons of this organization and had big impact in a large organization. But I was really interested in, number one, these conversations with women that were very empowering and engaging. Number two, this idea of impact investing, which we haven't yet talked about, but adding more than just return and risk as criteria that we look to invest. And I had effectively built our platform at my former organization, but it was, about 5% of what I did with my time. If you look at it in terms of the scale of the AUM, I had ultimately overseen $100 billion, and that impact platform was about 5-6 billion, which was very substantial. All those dollars are substantial. But again, when your purview is the whole thing, and only 5% of that was this area, impact investing, I sat at Erica's funeral and I just thought long and hard for many months afterwards about how I could make my best imprint, how I could make my best impact. And I wrote in a notebook, many months after that funeral, I wrote, this is the year 2023 where I'm going to align my purpose and my passion. And it's all going to come together, I thought, in the private markets and impact. And as it turned out, the founder of Copia, Chandran Thomas, was making similar notes in a notebook, except for his timeline started about 18 months before mine. And he had the courage to be the founder. I did not have the courage to be the founder, but I had the courage to join a really charismatic founder with a tremendous idea about directing capital in the private markets to diverse business owners. And so it came together with the universe. Sometimes if you manifest what your goals and dreams are and you put that out there in the universe, sometimes you get lucky. And that's what I feel happened here, that it really coalesced at a point in time for us to come together at the Copia Group. But it did take a life crisis, right? A life moment in midlife at the age of 48 for me, literally sitting at a friend's funeral and just thinking about the time that we don't have, the time that's not guaranteed, and how to maximize our time here. And I just felt the time was right for that change.
I see that with a lot of my women clients who, honestly, they're a little older than you often, but they've already done this profound work of parenting, of being a mom. But they're already at this place of legacy. What is my legacy going to be? I've raised my children, but what about the children of the world? How can I make a difference? And let's face it, we've added about 10 years to life expectancy since 1960. So we're not just living longer, but we're also living more vitally and healthily. And we're able
Hopefully.
to, hopefully.
Yeah.
I mean, on average, I have 80-year-olds that are still going on trips to Europe. It's not like the old days, my grandmother's generation. At 80, you were in a nursing home if you were alive, right? And so it's a long time from launching those kids, having a career, and let's say you retire in your 60s to, let's say, 80, 85, 90, even 100 years old. How do you make that rest of your life worthwhile? And that's where a lot of my boomer clients are. They have wealth, but they're looking for that reason to get out of bed every day. And I think, I know you know this, but at Stearns, we started a sustainable investing platform and immediately got between $50 and $100 million onto that platform. These days, ESG investing has become sort of a political football, and there's a lot of negative energy directed toward the imperfections of ESG, some of it warranted, some of it probably not. But what we're seeing is a desire. The desire hasn't gone away on the part of the investor. It's more, how do you do better? How do you do better with your investments? And we're seeing a lot of thematic investing, like directly investing into a fund that does something you care about, whether it's energy transition, climate, or in your case, what you're doing with equality, really. So talk to us a little bit about Copia Group and who you serve. What is the mandate?
Yeah, so much of what you said is resonating, and I want to double click on here as well, because I saw that too in my former life, and I saw women leading the way in impact investing. I saw female clients that were not previously as interested or engaged in their investments coming out of the woodwork and being front and center in driving those investments. And those stats are proven that, in fact, it is the millennial generation and women that have led the flows into impact investing, or otherwise known as ESG. But now let's talk about the state of play for ESG, as you said. We are in a political football moment on a couple of acronyms of the moment. ESG, which is environmental, social, and governance, and DEI, diversity, equity, and inclusion. And our fund is really at the crossroads of both. But here's where I think we're at, that the acronyms that started the movement have seen their time in the sun, and the time is now for them to evolve. To what you said, specificity is what's going to bring this forward, specificity and focus. Because the challenges in the public markets, if you're trying to achieve the E and the S and the G, first of all, you should be looking at the E, S, and G all as risk and opportunity measurement. It shouldn't be a separate silo. It shouldn't be a separate acronym. Your head of investing, your head of risk should be looking at all of those things, right? Because you can't make a real estate investment in Florida and tell me you're not focused on the E. In fact, you can't make a real estate anywhere in the world today and not focus on the risks of climate change to your land and to your building. Just talk to the insurance industry. Just take a look at their premiums. You'll see that is front and center. You don't need a separate sustainability officer. Your chief risk officer should be focused on that. So that's the change that's going to be occurring. And at the Copia Group, what we are squarely focused on is pulling out one of those letters. It's the S. The S has been incredibly underinvested relative to the E. And that's where we see great potential. So the E has been very front and center, as it should be, because the world's hotter. It's on fire. There's hurricanes. The headline of today is that category 6 is coming as a hurricane, or category 5. I've lost track of how many categories there are, but meaning they're getting so big, they have to come up with a new category. You know, all of this is related and super important to invest in. The S is a function of wealth inequality, capital, and access. And one of the early ways to invest in this was really real estate. But the Copia Group is not a real estate firm. We're a firm that's providing loans to business owners, and primarily ethnically diverse and women business owners. And why are we there to provide loans for them? First of all, the banks have withdrawn from this marketplace almost wholesale, and that's been a function of bank regulation. And so it has birthed what's called private credit as an asset class and as a standalone fund. So that's the first big secular trend. But the second is that there's unfortunate bias in the lending process, and that bias disproportionately impacts women and people of color as business owners. They are not operating worse businesses. In fact, what we're seeing is tremendous credits, really solid cash flows. It's just that going through the process for them as a function of their networks, as a function of a system that, like you said, finance and investment management hasn't really been built by them. And a lot of times people have implicit bias, inherent bias. It's not their fault, that there's just a gravity pull towards people like them. And that bias leads to those businesses getting less capital. And so whether we look at the overall state of play for wealth, or whether we look at business representation for diverse business owners, either statistic, it shows up as there's just far less of them. And we see an opportunity in the marketplace to back them. And so that's really who we are, trying to fill a niche in the market, an opportunity set that we think is relatively unfilled by not just providing the capital, but by providing counsel alongside that capital.
So I'm curious, let's just say that you snap your fingers, Copia Group is amazingly successful, and you have a ton of minorities and women who have these amazing companies. Are there any general stats that you can provide as to the efficacy of these companies? How do they perform relative to the typical, let's just call it, white male business? Are there any statistics around this?
Well, I mean, the statistics I think I can share in terms of our deal pipeline today is that the leverage points that we're seeing for these businesses and what we call the lower middle market. So we're looking for businesses with 5 to 150 million in revenue, and then cash flow, otherwise referred to as EBITDA, of at least $1 million up to 10 million. But we really are focusing on 5 to 10 million as a sweet spot. In this space of the lower middle market right now, the default rates are half of what we're seeing in larger businesses, number one. So small businesses are not riskier than large businesses. And the business flows that we're seeing that are predominantly diverse owned businesses, we're seeing leverage points and interest coverage ratios that are, leverage points 3-4 times, whereas in the larger end of the market, you're seeing leverage points that are 5 to 7 times. So again, that's a proof point of what we're seeing in access and flow. These are successful businesses. They need capital for growth. What they're seeking is to grow their people, to grow their marketing spend. So what they're seeking is loans to back, they're not backing necessarily equipment. And the banks would like equipment as collateral. But we believe in the people and their ability to grow. And we're going to kick the tires on their ability to back that up. But we're seeing very successful businesses. So this is not something where there's a return give up that's required to back this population of business owners.
Yeah, I know that when microfinance first came out, there were just amazing statistics on, such incredibly low default rates. With that it was actually surprising to people. They ended up being some of the best loans that you could make. So I suspect with your underwriting at the Copia Group, we're seeing some of the same kind of trends.
I think it's similar. Our average check size is going to be much bigger than microfinance, but I love that comparison, Holly, because it's a model that people have come to know and understand, and especially in emerging markets, there was a lot of momentum, and there should still be momentum around backing, especially women business owners in emerging markets with very small loans, is a real means to getting capital to underrepresented populations. Here, our check sizes are going to average, let's say, $3 to $30 million. So the businesses are much bigger than the microfinance world. But to your point, if these business owners have managed to get to the place where they're meeting our screens, where they have this revenue and they have this profitability, in many ways, they've overcome so many obstacles that they're likely to be stronger businesses. They're likely to be management teams that are operating at a level that's even stronger. And again, I don't want to make this about, the haves and have-nots, because I think that's one of the challenges with the DEI movement, that this is about inclusivity. We're looking to back businesses not only that are diverse owned, but businesses that provide what we call inclusive mobility. These are workforces and workplaces that are lifting people up, that provide an opportunity for hourly workers to become supervisors. These are workplaces that provide psychological safety to all populations, right? So these are places where people want to work. That's who we're looking to back. And that can come in all shapes, sizes, and colors. But primarily, yes, we're looking to back diverse business owners. And we find they're running great businesses and they're great managers of people. And so there's a real multiplier effect that benefits the employees, their suppliers, and their community as well.
It comes at such an important time, too, it feels like. I mean, the country is so divided, and it is the haves and the have-nots. And there's a lot of anger out there. So providing opportunities for people who otherwise would have no access feels really important at this moment in time, in my opinion.
I think so. And I think there's some stats which might take your breath away that, really cement that point. When you look at the wealth gap, so the Federal Reserve has a triennial study called their Consumer Finance Survey, and they poll thousands of families across the country. They've been doing this for decades. It's really the most reliable survey to look at how is income and wealth distributed in America. And then they ask similar questions around business ownership. And so some of the stats that really strike me as an incredible challenge are that for households headed by Black women, let's just use that as an example, the most extreme example, these households have 5 cents to the dollar compared to households headed by white men. So let me just kind of state that statistic another way. They have 20 times less wealth, 20 times. And Hispanic women-owned households or women-run households have 10 times less wealth. And white women have 2 times less wealth, right? So whether it's the cents to the dollars or the times, the statistics are really staggering. So 2 times, 10 times, 20 times. I mean, it's this shrinking. That's what we mean by the wealth gap. Another statistic here is the Black population in America is 14% of the population, but only 2% of business ownership.
Yeah. And I hear a lot of people rebutting that sort of stat by saying, well, they're not as well educated. They don't work as hard. You could say that about maybe an individual, but when you look across an entire group, it's hard to believe that there's not something systemic happening, right?
Well, there's a lot systemic happening. And I think those types of statements are a reflection of, look, our country's stark history, not just for people of color, but also for women. I mean, it was only 1979 that in America, and that's the year that we emigrated here from the Soviet Union, that's where I was born. I was shocked to learn that very same year was the first year in America that women could get a loan
By
without
themselves.
a cosigner.
I
So
know,
when
it's
people say,
shocking.
what's the problem? Let's think about just the women's population, right? Because we're over 50% of the population. So why? What are the problems? The history, the inequitable access to education is a real thing. So when people say they are not as educated, the educational system hasn't been as open to various populations for a long time, right? So it takes a very long time to change capital access, education access, literacy access, right?
Yeah.
But the
Yeah.
time is now. It takes decades for people to catch up. So this is not about charity. This is not a nonprofit.
No, it's not a
right?
handout. Like
It's
they have
not
to
a handout.
perform, right? I mean,
They
they
have
have
to
to
perform.
perform. They've got to get through your underwriting. They've got to provide returns. And apparently they're doing that in spades.
They're doing that in spades. And this is why this is what we call a non-concessionary return. In the world of impact investing, there are organizations that say, we're going to give loans at very different rates, and they're going to be concessionary. They're not market rate. This is a market rate strategy. And it's a market rate strategy because the market is there to provide those returns. So I push back strongly around perception, but it's an uphill battle. I think sometimes you got to get into those boardrooms and convince people that not only are these businesses deserving, they're potentially more deserving, right? That the characteristics are stronger. And we're humble at the Copia Group in terms of our expectations. So we start out under promising and hope to over deliver, but we're excited about what we're doing and finding those great organizations. But I applaud you in unearthing those questions and throwing out the objections because they're real.
Yeah, no, I think we do it a disservice if we don't talk about what it is you're trying to combat, right?
Mm-hmm.
This is what we're actually trying to combat. And like you say, it's non-concessionary. So you can, as a woman investor, any investor, you can invest in your group and expect market-like returns for what you're doing. And you're also helping. You're also putting a little dent in the lack of access that many groups don't get to enjoy, right?
Yes. And there's lots of private credit funds out there. So this is a growing and big asset class. And the types of returns we're targeting are low double-digit returns. So those are substantial returns for loans. And that's a reflection of where we are in the rate environment. As you know, rates have been higher and the Fed may be moving them down shortly. But the big picture perspective is what makes us different. And what makes us different and where we find appeal in those that are backing us is people are looking for something different. They're looking for something that's a smaller universe in a way, that's a harder to find universe. But once you're in that world and you can network your way in there because we look like the universe, right? That's how we find these entrepreneurs. That's who we appeal to, is investors that care about social equity, in particular racial equity and gender equity lens, like you said, thematic type. So I know you've had investors come to you and say, look, I want to back alternative energy. Okay, that's great. Now you have funds that can do that. I want to back infrastructure. Okay, we can do that. Or affordable housing. Great, we have funds that can do that. Well, this is a fund that's focused on how do you back social inequity? How do you get capital to, again, not a nonprofit, but how do you get capital to profitable businesses that just in this system of capital access haven't been able to get that capital the same way. And so that's what we're about.
And so tell us, how long has Copia Group been around and what is your fund size or your targeted fund size?
Yeah. So Copia Group is a relatively new venture. As I mentioned, I had my moment sitting at Erica's funeral now almost 2 years ago. And then it took me a long time to consider and think about the decision. And Chandran was planning for years his exit. He was a very senior executive at Northern Trust, both of us in Chicago. The Copia Group is a Chicago-based fund. And we all came together, 5 of us, to launch Copia about a year ago. So we launched officially in the fourth quarter of 22. We've raised about $40 million. So it's not a small amount, especially in a really tough fundraising environment. And we're going to keep going. We like to see the Copia Group ultimately get to 300 million or so, but we're already deploying the capital that we've raised and out in the market, really raising our profile with those diverse entrepreneurs. We look forward to a long runway.
Yeah, I hope so. Tell our investors out there, is this a qualified purchaser type of investment? And what is your minimum investment size?
Yes, it's not for everybody because the capital is locked up, and the type of fund that we are is, as you say, a qualified purchaser. So individuals have to have $5 million in net worth, and institutions 25 million is the qualification standard. So most of our investors are more institutions and family offices, but we do have high net worth investors along with us, and our minimum is 500,000. We do set that minimum high because the capital is locked up and because the majority of our capital that we've raised has been more institutional.
So let's finish with this. For those investors out there who can't afford a Copia Group, is there a public security option available that does the same sort of thing?
I wish I could answer that with a yes. I am not aware of one. Maybe you are, but I think this world of impact and credit is starting to emerge. This is a relatively new concept because what's happened in the field of impact investing is, when I say impact, what I mean and how that's different from ESG is that you're intentionally measuring and moving the needle on outcomes. So what we have here is an impact fund where not only are we going to be measuring return and risk and, of course, all the characteristics of the loan, but my job as the chief impact officer is to say, which impact metrics are we going to move the needle on? Is it pay? Is it hours of training? Is it percentage of the population that's formerly incarcerated in your workforce? Is it diversity in your workforce and leadership and ownership, right? So we're really holding ourselves to this standard that's higher than what I would say is a traditional kind of quote unquote ESG fund, which has less of an obligation to move the needle. They may be measuring, but they're less of an obligation to move that needle. So I think that's hard to do in the public markets. That's where I'm getting to with this. It's
I think
the
it is.
private
And
markets are a different animal for this.
And I think that's one of the pushbacks on ESG is it kind of makes everyone feel good to do it, but we're not sure what the impact really is, right? And so that's the thematic investments like what you're doing, you can actually see the impact.
I think private market investing, that was another thing I wrote in my notebook in 23 is that I really had spent much of my career in the public markets and the majority of my asset exposure was public. But of course, I also spent time in the private markets. And the more I spent time in this space, the more I thought this is really where there's a return opportunity that's untapped, that it's an inefficient market. Anything that's inefficient and hasn't been arbitraged away is where there's more return opportunity, right? And I think, and we talked about how in your own asset allocation advice, you recognize private markets are really complementary to the public markets where you can be more efficient. Yes, you have to give up liquidity. Yes, the fees are higher. And that's all because I can tell you, we're out there finding these entrepreneurs, right? This is harder to do than going to an index fund in the S&P 500. And so there's a premium, there's this return benefit to that in the private markets. And that's why I wish there was a great public option, maybe in microfinance and emerging markets. I think maybe there's some more liquidity there and some firms that have been around longer doing that. But I don't have that list for you yet. But I hope we'll both keep looking for those kind of smaller ticket ways to do it.
Yeah, I think it'll come. But in the meantime, what you're doing is amazing. Your courage, so inspiring. The work that you're doing, so meaningful. So thank you so much for the work that you do. And thank you for joining us and telling us a little bit about it, Beata. Thank you.
Well, thanks right back at you, Holly. I think we were introduced in a way of women helping women and women really being engaged in this network that's broad, right? I'm in Chicago, you're on the East Coast, and there were great women that put us together. And that's what gives me a lot of hope that there are so many of us just moving the needle forward in different ways and in different seats across the country. And frankly, it takes all of us. it takes an army, it takes a village,
Mhm.
whatever quote you want to end with here. But all of us just have to keep on showing up to do the work to move the needle. So the
Yeah.
thank you goes right back to you for the effort that you put into programming like this and the work you're doing with your clients to provide them options and education and opportunities. So it's really a pleasure.
Oh, you're welcome. Take care.
Haleh Moddasser, CPA, is a partner and senior wealth management advisor at Stearns Financial Group, an investment management firm with offices in Chapel Hill and Greensboro, North Carolina. Securities are offered through Hightower Securities, LLC, member FINRA, SIPC. Hightower Advisors, LLC is an SEC-registered investment advisor. Refer to brokercheck.finra.org for more information. This podcast is copyrighted and all rights are reserved. The content of this podcast is for information only and not intended to serve as financial, legal, medical, or any other form of professional advice.